Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash flowing properties in today's market. Here's your host, Gabe Peterson.
All right. Welcome back to another episode of the Real Estate Investing Club. It is Snowmageddon all over the U.S. right now. I am down in California still, so luckily we do not have that. It is cold here, but it's we're not seeing the snow. But my family up in Washington has been saying they're starting to get it. So hope everybody stays nice and warm out there. We're gonna heat you up a little bit with some knowledge on real estate. Today we have Dobbs Ackermann with us. He is a multifamily man with over $1 billion in total assets built and acquired. Billion with a big B. So that is a big number, and I'm sure he has a lot of wisdom from all those transactions. So Dobbs, thank you very much for hopping on the show.
Hey, thanks for having me. Appreciate being here.
Absolutely. I told you right before we got on here, we like to start with stories. So take us back to the beginning of your story. How'd you get started in real estate?
Great. So company started in about 1938 from my grandfather, built 4-family apartment buildings, would build them, lease them up, sell them to investors, do it over and over and over again. My father got involved in the 60s, and he really started doing all sorts of construction. Started a fairly decent-sized construction company, did housing, warehousing, storage facilities, built churches, built car washes, land development. I worked in the company ever since I was about 12, sweeping floors, digging ditches, running heavy equipment. In 1992, when I graduated from college, I came into the business and started working in all facets of real estate and all kinds of these different asset classes. And in about 1998, I came to my father and said, I think we need to concentrate on one thing, and we should pick which one is the best asset class we've been involved in historically. And we believed that to be the apartment industry. It was the lowest risk profile of what we did. We had a good infrastructure for it. And he believed in what I was saying. And in 1998, he not only believed in what I said, he said, well, why don't you just go do it? And he handed the reins over to me, and I started the process of getting out of all the other lines of real estate that we were in, which took about 10 years to do. And then started trying to take what was a 400-unit portfolio of apartments and then start to turn it into a business concentrated on building and buying apartment communities in the Midwest.
Very cool. Yeah, I even, you and I were talking about this right before we got on here. I was mentioning like it's really hard in real estate to not get the shiny object syndrome where you're just like, oh, there's this asset class, there's this asset class, there's this strategy, and just bounce around to all these different things. But it sounds like you guys really, or you recognize the value in sticking to one asset, mastering that asset, understanding it through and through, really build vertical integration in that one asset. So it makes a lot of sense. When you made that decision, what were some of the kind of growing pains, I guess, that you guys experienced? One, divesting yourself from all those other assets, and then two, focusing on multifamily.
Well, I think your comment on the shiny objects is right on. I mean, anything you can make money on in real estate becomes very attractive. And so trying to be disciplined took 10 years to actually do it. It was really hard. And then the other part, well, I will say that I do think that the business has to follow your personality. And apartments is a people business. And if you like building a big team, if you like creating an environment, I think the business has to follow your personality and the personality of the group that is here. And my executive team, a lot of them have been here for over 25 years. And it fit with the team, the personality of what we were doing in the business around apartments.
Yeah.
And so we really just started building the systems from historic management and approaches to construction and finance to then build a company around apartment acquisition and development.
Yeah. Yep. That makes sense. You mentioned earlier you chose apartments because you said it had the lowest risk profile. Is that completely based on a demand perspective, or what else? Because I even mentioned this before the podcast. I've thought about buying apartments in the past, but I always get cold feet because I know I've done single family flips, and I know the minute you put a hammer to those walls, there can be something behind the walls that you had no idea, and it could just completely destroy your underwriting. So I know that buying a large multifamily property does have risk. So what do you mean by it had the lowest risk profile?
So when we looked at all the things we were involved in, retail, office, land development, home building, storage facilities, car washes, warehouses, there was something unique about the apartments. And while they didn't always make the most money over certain periods of time, they were the most consistent of always making money. And so we thought from an investment perspective, we originally just did this with our own money. And now in about 2008, we went to using investor money. And then now we build funds and bring all the investors together into multiple deals. We thought for ourselves, we wanted to take a conservative approach in regards to using other people's money. And so to us, that also meant picking a more conservative asset class, and that was apartments.
Yeah.
And my grandfather would say, and my father would say, everybody always needs a home. And so if you build or buy the right property and you keep it in the right condition, constantly reinvesting into it, while you may not make the most money out of everybody in what you're doing, you will have a very consistent approach. And that's what we really were looking for in what we were doing.
Yeah, that makes sense. I just read, I can't remember which report it was, but I read that apartments are getting to the point where it's overdeveloped in a lot of major metros out there. Is that what you guys are seeing? Are there specific metros that you feel still have a lot of opportunity on the development side?
I think we are seeing that as headline news in a lot of major markets. If you look at where we are in the Midwest, we do not experience that. If you look at second tier markets, which is really what we're concentrated on, we do not see that. We take a pretty specific approach to this, and we look at the demographics within a marketplace, and then we look at the creation of jobs. Apartments follow jobs. And in a lot of markets, we see there's job creation 4-to-1, 5-to-1, 6-to-1 versus new construction of apartments. Okay. It's pretty easy to do. If you just look at your jobs reports and your demographics, where you want to be in a community, your rent profile, you're able to see how apartments will fare in a market. Yeah. A lot of the very hot markets, Charlotte, Nashville, Atlanta, the Texas market, some of the Florida markets, some of the markets out west, Denver, they are blowing up, and they've built so much that I think we're going to see a little bit of softness. But if you look at a lot of the other markets, second tier markets, Midwest markets, we just aren't going to see that. We don't have the construction volume that's occurred, but in a lot of the markets, we're now starting to see a lot of job creation that's occurring. And that's really what we're following and looking for in regards to markets that we want to operate and buy in. We just think it's a much safer avenue. It may not be as glamorous as some of the big markets, but you can have a steady return and a safer return when you look at the long run of being in in the market.
Yeah. So second tier job growth, second tier markets with job growth is what you're looking for.
Yep, absolutely.
Yeah, that makes sense. So you already mentioned that, one of the steps that you took when you decided to go all in on multifamily was you had to build your team around multifamily. How did it change from the team building perspective? How did that change when you went from looking at all these different type of asset classes to looking at just one?
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
Well, it morphed, and it took a lot of time to figure this out. I would say we really didn't figure it out until about 2016, and we had to figure out what the purpose of our company was. And
for the 2020 spike, right?
Yeah. And what we finally realized was the purpose of our company was about the people in our company. And so we really understood through our guiding principles, did we have the right people on the team? Did we have the right purpose around what we were doing as a business? And what changed for us is we have taken an approach that what's first important is the people in our company. And if we can figure out how to operate and run a company dedicated first to the people that work in it, then those people, because they have the support, the structure, and the environment, they actually are in a position to then take care of people that live in our communities. And so we were able to take our guiding principles from a company perspective and then start to look at how can we move that even out to a community perspective. And ultimately, we then created operating principles at the community level to create our voice. You have 400 people, 600 people living in a community. That community can quickly take on its own personality. And sometimes that's okay. Sometimes that's not okay. And so we wanted to make sure we were creating the voice and the environment that we wanted even down at the community level, but we had to start at the company level to really be able to do that. And so when we take a people first approach, it's people first in our company, and by serving them, then we can actually serve our communities. That took a really long time to figure out of what that meant. I mean, it starts with salary and benefits, then it goes to culture, then it goes to environment and condition, engagement, communication. It's a lot that all of a sudden you're trying to dissect to really then operate, we think appropriately, a large scale format of running real estate, knowing that we want to self-manage. We only want to buy things that we're going to manage ourselves. We've just had a lot more success doing that than handing it off to third parties.
Yeah, that's something that I mean, everything you said rings really true for me. When you're making small tweaks at the top, especially when it comes to like policies, values, that kind of things, it really has an impact all the way down. It's something that I really want to get, my company to the point where we can bring everything in-house. And because I feel like that really does have an effect on the return that you get on the property and just how the quality control that you can have with operations. When you're using third-party property management, of course, there are good property managers out there. I don't want to, say anything negative about property managers. They do great work. But if you can bring it in-house, then you really have a lot more control And you can make sure that what's happening at the property is in line with your values and what you're trying to accomplish. So I like that.
We've found that we can get a couple more points of return, a couple percentage points of return. That's a little bit better. And then we can also, we get to spend a little bit more time on the asset condition. And combined with that, we are able to position a property from a long-term basis in a condition that in good or bad markets is going to maintain occupancy and income. And we've just found that critical when we typically look at a 10 or 12 year horizon on any property that we buy or build for a hold period. Yeah. And then looking for the opportunity during that 10 or 12 years for where is the job market slowed? When we see a peak coming in the market based on cap rates and interest rates, is there an opportunity then to sell and really garnish the highest return we possibly can, while at the same time looking at our team and making sure that we're not making a poor decision for the team that's within a particular region of losing scale to operate.
Is there a return on IRR that you guys kind of have as a baseline that you want to achieve? I know every market's going to be different, but is there a specific number that you shoot at for all your properties?
So in our funds for just buying existing real estate, we look at a minimum of a cash on cash return of 8% over the life of the deal, and a minimum of 12% IRR over the deal. Now, historically, we've been able to operate north of a 20% IRR over the last 15 years. So we've had some great numbers. When it comes to underwriting, we use that as the baseline of what we're doing. And then we look for the opportunities that we can begin to bring. Maybe there's a little bit more income through cable and internet. Maybe we are able to, through our utility programming, able to garnish a little bit more efficiencies for the tenants and for ourselves in regards to some additional income there. As you go into a market and you get a little bit of scale, you're also able to then drive some of your efficiencies from a management company, so you can bring a little bit of dollars back there. So it's just a lot of little parts and pieces that you've got to start with your baseline of what you know. So that's the minimum. If you've got a minimum and you know you can operate on to that, then our approach is then to just say, how can we start chipping away at that? And can we get to 13? Can we get to 14? Can we get to 15? Can we be advantageous in the markets on how we structure the deal? And then can we start driving that return? Oh. And one of the biggest things I just wanted to get out to everybody, if you don't mind, is there's one program that's been the most successful program we've ever seen in our history. We've partnered with Freddie Mac on almost every one of our deals, and they have something called a supplemental loan process. And that is where you lock in your base debt when you buy the deal. And then as you increase your net operating income, you're able to go back in small tranches of $1 million minimum every year, or I think the first 7 or 8 years of the deal, and you're able to add to your loan. So your original loan is locked, and its rates and its term.
$10 million, 5%, let's say.
And then you get to add each year based on your growth in NOI, never really going outside of your loan to value covenants from the original structure of the deal. The key to it at the end of the day,
HELOC. I mean, I'm just going to use that word, but you're essentially doing a cash out refi, but you're not refinancing. You're just adding debt onto the existing, agreement that you already have with the bank.
That's right. And the key to it for any of the investors out there is we always want risk off the table. And so by returning equity, we want to get that risk off the table of the original equity that's in the deal. And so this helps your IRR. Historically, we've been able to return about all our equity within about 5 to 6 years now in regards to our structure and our approach. And as we think about investing in real estate, it is about the return. Yes, we are a management company. We have all of our goals and our approach there. When you think about an investor, it's about the return. We have a job to do. We got to get risk off the table. We've got to create return, and we've got to do it as fast as we can. And we got to protect the asset the whole way that we do this. So I just think if anyone has a chance, they should look into this program, nationwide program, very well structured with Freddie Mac. We just think it's a magical tool in the apartment industry to be able to use.
Hey, can you repeat the name of that program again?
It's called a supplemental loan program within Freddie Mac.
Interesting. Okay. Yeah, that's the first time I've heard of that. That's makes a lot of sense from the bank's perspective as well. So yeah, it seems like a really good tool that you can use to really augment your return for the investors that are along for the ride.
And what you're doing also is, yes, you're giving return to the investors, but you can also take a good portion of those dollars as well and put it back into the property. So you can constantly improve your asset, which in turn constantly puts you in a good position within the market. And when we think about numbers, the average apartment owner invests about $500 per unit per year into their apartment.
Oh, interesting.
We invest about $1,000 per unit per year into our apartment. And it makes a difference really when you think about your clients, because they see that investment and then your turnover ratio lowers.
Yep.
Biggest cost?
Yeah.
Vacancy and turnover. Yep. So how do you try and mitigate that while, by the way, you're improving your asset value the whole way? So simple stuff, that you just get to learn after doing this stuff for a long time that I hope some of your listeners will be able to benefit from.
Yeah. Yeah, it's those small improvements to your approach that really make the difference, over the long run. So I'm sure that's a unique program. So I'm sure hopefully people take advantage of that. Sounds like a good one. So we have run through our time. I do have to push us on. Before we do, though, so you mentioned 8% cash on cash and then 12% IRR. Is that just baseline? So you're like no improvements, no value add. That's just what you expect to buy. And then over the course of the 10-year period, you expect an average cash on cash of 8%.
So we do bake in the assumption of improvements if we are doing a repositioning. About half of what we buy, we reposition and do about $25,000, $35,000 per unit on for a reposition. So we do bake that into the assumptions, but it is a baseline. We assume that we are going to hit a minimum of mid-teens returns or our historic returns of over 20% IRRs. That's our objective in what we're doing.
Very cool. All right, I'm going to take that as an opportunity to move us along to the quick question round. Are you ready?
Sure.
Let's do it. It starts with books or any form of education. It could be YouTube channels, documentaries, whatever, Netflix shows. I just need 2 recommendations, one for general life wisdom, one for real estate.
Okay. So general life wisdom, I'd go to the International Builder Show. Anybody who hasn't done it, there's a multifamily housing section in it. It's in Las Vegas every year. You're going to see all the products you can ever imagine, and all of the programming that is out there is fantastic. So great thing, great experience to have. I've done it since I've been eight years old. Would go with my parents, and it's just a fun thing to do, and you learn a lot. The second thing is follow the real estate section in the Wall Street Journal. So many people talk about it, and we all get lumped together. Right now, people say the apartment business must be terrible because they read about what's going on in the office world. It's not accurate, but you need that basis. You have to understand what's happening in the global real estate market to understand what's happening in your market, and you have to be able to speak to it. So I've really found that the Wall Street Journal is fantastic in bringing a lot of that voice to the table. And you get it every day. So it's just sort of an easy, fun thing to do that everybody can just get the app and read the articles. And I think probably take a lot on how they want to do it.
Yeah. Good recommendations. The International Builders Show, that sounds like a lot of fun. I like conferences. I've been wanting to go to more just because, I say this, I've had this conversation with so many people on the podcast that the more engaged you get with the broader, community of real estate investing, the more fun it becomes, and also the more connections you make and the more opportunities that kind of cross your desk. So good recommendation. Also Wall Street Journal. I have a subscription to the New York Times. I've been thinking about switching over to the Wall Street Journal. Might have to take this opportunity to do that. So thank you for those. I'm going to move us on to the next one. And this is for your younger self. So let's go back to the Dobbs back in, let's see, what was that? 1992 when you entered your family business. Go back to him, look him in the eye, give him one piece of advice moving forward.
The one piece of advice I would say is it's all going to work out. Like we all set a lot of expectations on ourselves and put a lot of pressure on ourselves. And I think if you just get up, go to work, come up with your plan. By the way, write down your goals for yourself, your health, your family, and your work every year. Revisit them every month. Just go through it. Don't make them overwhelming, but just be consistent about it. Then just get up every day and try and go to work. And it's amazing when you do that, how things actually happen. And I think your younger self is always questioning, how am I going to get there? What am I going to do? How am I going to do it? It doesn't matter. Just create the goals, write them down, start doing it. And somehow, some way, magically, it just happens when you dedicate yourself to it. And so you just take the pressure off.
Yeah, that's something I still struggle with, if I'm honest, is just kind of, just doing the work and not being so worried about, will we actually reach our goal? I feel like that's really good advice, especially when you're younger. I've gotten better. I'm 37 now, so I've gotten better over time. But definitely when I was in my early 20s, I was like, go, go, go. I have to get there right now or else the world's going to collapse. So good advice. Moves us to the next question. This is about the U.S. It's a big place. There is a lot of opportunity out there. So give me one single city area that you're most excited about investing in today.
Columbus, Ohio. And so we're in Cincinnati. We do a lot of work up in Columbus. The growth of business in Columbus is phenomenal. They call it the Intel effect right now. Intel, Google, Facebook, they're all building. And I think this is going to happen in other places in the Midwest, Indianapolis, Cincinnati. But these are very affordable markets to be in. There's a lot of job growth when we look at what's going to happen. There's a lot of resources and tax benefits for being in these areas. And I think we're going to see a big push in the Midwest or any of these intercoastal cities that are more working towns, but unbelievable lifestyles. I mean, not expensive, can do everything you want, low stress. And because it operates like that, then you can have fun and travel and build a great family and environment and really do anything you want. So I'm a big proponent of this kind of middle region within the U.S. that I think is going to end up having a lot of advantages for lifestyle when you think about building wealth, building your environment, and creating a structure around you that is the way that you want to operate.
Yeah, that rings true, especially we're in California right now, Santa Rosa, and I think the average house value here is like 600 something thousand. It's not sustainable. Who can buy that?
Right.
Working a normal job. So yeah, Columbus, great suggestion. We own a self-storage facility in Indianapolis, and I've been wanting to buy more out there because I really like that area.
Home run.
Yeah. All right, next question is about finding the deal. It all starts with getting in contact with the seller and writing up that purchase agreement. So what is your favorite way to generate leads and find new deals?
We do it two ways. We do it direct. So we keep a listing of every property that we would want to buy in each city. so we know what they are. And then we reach out to them. We're a known quantity in our region, so we get an opportunity a lot of times to have a conversation. And then the other 50% we do with brokers. And you have to have a relationship with the broker. We get a lot of deals because we know the brokers. They know how we're going to perform, and we're a known quantity in regards to delivering. And so I think it's not only the contact, but you have to deliver on what you're going to say you're going to do, and you have to be at or better than market. And so what I mean by that is, when you sign up a deal, you got to get the contract done within a week or two. You've got to get your due diligence done within 2 weeks after that. You have to have your financing.
That's quick.
You have to have your financing running a parallel path, and you have to close in 60 or 90 days.
Yeah.
And you got to have your equity already sitting there. So I think it's being extremely prepared and being able to act and follow up and do exactly what you say you're going to do for the seller, to have the confidence in you as a buyer.
Yeah.
And a lot of times I would tell you, we're not the high price, but we are known, we might be right there, right close at it, but they know we're going to close. They know we're going to follow our path. The seller knows it and the broker knows it. And there's a confidence that this is going to close. And by the way, they have to close. Like, the sellers have to have these properties close, or they create a lot of ripple effects for everyone down the line.
Yeah. Building that reputation is so important. I still have not added brokers to my outreach. We do all off market, but it's something I need to do, because everybody comes on here, especially with people as much experience as you do, saying, 50% of our deals come from brokers. So good advice. Moves us to the next question. And this is about your business. I know you kind of stepped into the shoes with your dad and your grandpa. Let's consider if you were to just completely walk away from everything and start your own business, completely new, fresh, just you and a pad and paper, maybe a computer. If you were to restart your business, what would be the first 3 positions you hired, and what order would you do them in?
So one, I would do it as a team. I would not try to do something by myself. It's too hard. There's too many critical aspects. So I'd have somebody in finance that understood the numbers. I'd have somebody in operations that understood how to run and maintain a property in the right way. And I'd have somebody dedicated on acquisitions. It's a full-time, doesn't matter at what scale. If you're buying a couple houses a year, it's a dedicated approach in each one of those areas that are critical. You have to know how to operate, you have to know how to finance it the right way, and you have to know how to find the deals. And so I would really start with that, but I do it as a group, which I know that can seem hard to bring on partners, but each piece of this has its specialty. And I think that's what's critical in our business. It's not a complicated business, but there's so many parts and pieces to it that you realize that you're just not going to be an expert in it all at any time. You have to find the experts in those parts and pieces, put them together. The scale of it will find its success. And this is one of the one businesses in the world. There's plenty of money to go around. You'll never have to worry about that. That's not the problem. It's making sure that you've got the right team that you've put in place to do this the right way.
Yeah. I feel like that's finance, ops, acquisitions. That is the perfect trio of partners to start a venture. It is difficult to find good partners out there, I will say that, but when you find them, you got to hold on to them and go on the ride together. All right, next question is, I lost my spot, so give me a second. Biggest lessons learned. Not every deal that we go into goes the way we expect it. A lot of times a wrench is thrown into the system and a deal goes a little bit sideways. So what is one deal that went away that you did not expect, and what was the lesson that you pulled from it?
So the biggest lesson learned is time really matters. We do a lot of um, improvements at our properties. And so we'll buy a deal and then we'll go through and redo the kitchens and baths, electrical, plumbing, and we'll reposition the asset. Um, and we've learned through a lot of hard lessons that if we're not set up to do that the right way and we don't do it in the right amount of speed, one, it's going to cost us too much money. We're not going to get the rhythm and the effect on the unit that we want. And two, time is money. So you think you're going to get a unit online and you don't get that rent bump when a renewal comes, then you've left a lot of money on the table. And real estate is, in this case, when you're looking at that operating income, when you didn't get that dollar in that month, that's gone forever. So the effectiveness of how you build, the speed at which how you build, how you move the rents if you're doing a repositioning, we have taken a lot of lumps over the years. We finally have it down, but it's critical to make sure that you've made the right assumptions and structure when you set that up. And today, now we do a rapid renovation, and we can remodel about 3 to 5 units occupied in one day.
Wow, that is impressive.
Yep, kitchens, baths, electrical, and plumbing. And then we know we can do a 300 unit community in about 6 to 7 months. And we know that when that unit turns, that we are ready to get the repositioning on rent that we're looking for. Or when the lease renewals, we can take them through a stepped up process over usually about 2 years, so we don't impact the renter too heavily. But man, did we leave a lot of money on the table over the years that I wish we would have done a better job.
Yeah. Well, I mean, that is something that definitely comes with experience. That's not something that if I did that right now, I would not be able to hit a day. Absolutely not. So that is quite a feat to be able to do. And, time is money. Absolutely. And now that you guys are there, you guys have definitely a competitive advantage, over the competition. So, I'm going to move us on to the second to last question. This is about your strengths. We're all gifted with gifts that we uniquely provide this world. So what is your Superman strength?
Well, I would say it's communication and care. What's your purpose? My purpose is to make a positive impact on the people around me. And so can you connect that to a business that you're doing? And can you make a difference in somebody else's life? And what's been so surprising to me is somehow when you concentrate on somebody else's well-being and success, how in turn that comes back to you tenfold. And so I would just say for all your listeners, man, spend time on other people and what you can do for them. And somehow, some way, that is going to reap 10 times the rewards back to yourself. And it's a lot of fun. It's a mission. And so I feel like that's my superpower strength, although it's just not that hard. So it feels kind of silly to say, but I think, probably caring for others is the key to having success long term.
Yeah. And it's almost counterintuitive. But giving to others really does give you the most, even though that's not the goal you're trying to give to others, but it just works out that the boomerang effect just comes right back to you. So that is a good strength to have. And that leads us to the last question. This is for the listeners. I'm sure people want to reach out, get in contact with you. What is the best way for them to do that? And what can they expect when they do reach out? So
AckermannGroup.com is our website. Ackermann's with 2 N's. My email is Dobbs, Dobbs, at AckermannGroup.com. I'm happy to take any email and provide any advice that I can. I'm a huge proponent of the real estate market, particularly apartments. We don't have enough people in it. We need more people in it. And I think anyone who's interested in getting involved in real estate, it is a great business to be connected to. So encourage anyone to reach out to me, and I'd be happy to shed any light on that I can that may help you.
Perfect. So that's ackermanngroup.com, ACKERMANN group.com. I'll put that link in the show notes. So if you guys want to reach out to Dobbs, just click the little more in the description. It'll pull down that full description, and in there you can find his links. All right, Dobbs, that wraps it up. I appreciate you hopping on the show and sharing your wisdom.
Hey, thanks so much. Appreciate you having me.
Absolutely. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe, therealestateinvestingclub.com. If you guys want to support the show, just give us a like, subscribe, share, all that jazz. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.
All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.